Today, I'm again joined by John Ulzheimer, one of the top experts on credit reporting and identity theft. He has over 33 years inside the industry working for giants like Equifax and FICO, and he brings a unique insider perspective that few others have. John, thanks for joining us again.
John, thank you as always for having me. I appreciate the invite.
And just like last time, we're going to go over some questions from our social media followers, readers, and just from around the credit space that people are really interested in.
Sounds good.
So our first question is, I was a few days late on my credit card payment. Will that show up on my credit report?
So the short answer is no, it will not. And here's why it will not. First off, whoever the person was who sent the message in should set up one of the variety of ways that they can track their due date and not miss due dates, because the credit card issuers they don't want you missing due dates. Due dates are not a suggestion, they're a real thing. But from a credit reporting perspective, the answer to the question is no, it will not. And here's why. Many years ago, decades ago, in fact, the credit industry, the big three, Equifax, Experian, and TransUnion, created a set of industry standards that all three of them follow. And those standards are set forth in a 350-page manual that's about yay thick. Unless you're someone like me who is really into this stuff, it's incredibly boring, and it's all alphanumeric code with the credit reporting language. But that booklet, which is called the Metro 2 Manual or the Credit Reporting Resource Guide, sets forth the credit reporting standards and guidelines. And one of the topics that is addressed is late payments. And for decades, the same rule has applied, which is that if you are between 1 and 29 days late on any obligation, whether it's a credit card, auto loan, student loan, boat loan, whatever, the creditor cannot report that to the credit reporting agencies. In fact, systemically, meaning electronically, there is no way to report someone as being 1 to 29 days late to the credit bureaus. It doesn't exist. So the answer to the question is no. So the industry kind of gives consumers this kind of built-in 30-day grace period. But again, there's a difference between being late on a credit report versus being late with your lender. If you're late by a day, you're late, and you may get hit with late fees. You may start getting phone calls from your creditors. Obviously, if it's a credit card, you're going to pay interest on the unpaid amount, which is probably all of it if you haven't made a payment. So there's a lot of bad things that happen if you miss payments on credit cards. But credit reporting, which could be one of them, obviously, that wouldn't start until you're at least 30 days delinquent. Now, what that means is if you pull your own credit report, which you should do periodically, and if you see late payments on your credit report, then you can walk away from your credit report knowing that every single one of those late payments indicates that you are at least a month past your due date. So what it does, John, is it eliminates the statement got eaten by my dog and the check got lost in the mail. It eliminates all those kind of common but lousy excuses as to why you didn't make a payment, because you have a full month to make that payment before it ends up on the credit report. So that's, for people who choose to vilify the credit reporting industry, you should send them a thank you card, because they're giving you this 30-day grace period. They don't have to. They can create a code that indicates 1 to 29 days late, but they just have never done anything like that.
And I think that's a good clarification, because we get that question a lot. And I think it's because the credit reporting agencies have a different definition of what is late than the issuers. So if you're a day late, you're late, and you're gonna pay you might pay a penalty, but it's not going to go on your credit report because they have a different definition of late.
That's right. Now, on a credit report, if you have a 30-day late payment, what that actually means is you're 30 to 59 days late. Now, once you hit 60 days late, they can immediately report you as being 60 to 79 or 60 to 89 days late. They don't have to wait another 30 days before they report you late again a second time. You only get that 30-day grace period for the first 30 days of the delinquency. And after that, it's every 30 days They can hit you 30 days, 60 days, 90 days, 120, 150, 180. And you don't get that grace period except for that first 30-day period.
Yep. So never let that 2 days turn into 30.
Correct.
Our next question is, why does my credit score change so much from month to month?
Yeah, good one. So this is one of those questions that has like a lot of answers. So I'll limit it to just the most common ones. The most common and appropriate answer, I think, to this question is the reason your credit. First off, your credit score is not a permanent part of your credit report, meaning that if you pull your credit report, there's no credit score on it.
Mhm.
You have to go to one of the different services that include your credit score. Sometimes you may have to even buy a credit score, even though there's a lot of places to get them for free. But if you look at the definition of what is a credit report or consumer report, credit score is not what is not included. A credit score is what's referred to as an ancillary product. It's like the leather interior of a car. It's an optional add-on that a creditor has to buy from a credit bureau. It doesn't come with the base model, which is just the credit report. So that's why you don't see the credit score kind of going up and down over time, like you'd say, for example, a thermometer
Mhm.
going up and down as the temperature changes. Um, as the information changes on your credit report, there's no guarantee that your credit score is going to be the same every single time it's calculated. It should be similar unless some sort of like a black swan event occurs and all of a sudden you have a new collection hits your credit report, or you just defaulted on something, or you just filed for bankruptcy,
Mhm.
or you just had an account get charged off. So unless you don't have one of those types of events, then your credit score should stay in a relatively tight band, usually plus or minus 25 points. That's kind of the normal organic movement of a score over time, but there's no guarantee that your score is going to be the same because every single month, everything on your credit report changes. Number one, it's all 30 days older than it was 30 days ago. So everything is now 1 month older, and that is influential in a credit score. And balances on credit cards may be different, balances on loans may be different. You may have inquiries that have been added. You may have inquiries that have aged off. You may have delinquencies that are new. You may have delinquencies that have aged off. So your credit report is kind of this like this living, breathing, dynamic thing that goes through a series of changes every single month because that's generally how often your creditor report is. It's once a month, and it doesn't happen on the same day, and it doesn't necessarily happen on the same day across credit reports. So it's not uncommon for consumers to have different credit reports over time and across credit reporting agencies. And so that's the primary reason why your scores are going to change month over month. The second is it's kind of an apples to oranges type of discussion. There are literally dozens of different types of credit scores, and they're not all the same. So just because you may have two identical credit reports, they may have different credit scores because the brand and the variety of
Mhm.
score may be different. One may be a FICO auto score, and one may be a FICO bank card score. Still a FICO score, but they're not the same scoring system. And so the score output is going to be different, even though it looks like the same exact credit report. So this is nothing to be concerned with as a consumer. Your scores will change over time. What you don't want to see is your score going from 800 to 710 to 740 to 680. That's unhealthy. So
Mhm.
if you think of it as an EKG, it's an unhealthy EKG. We want to see it stay within a relatively tight band. And really, the primary reason why the score is going to change over time in a normal environment is your credit card balances are going to change and your utilization ratios are going to slightly change. They may be a little higher 1 month, maybe a little bit lower 1 month. And so your score is going to respond accordingly, but it should not be this radical difference in scores month over month.
So basically, there's no cause for alarm, but it will change based on the information that's on your credit report changing.
No cause for alarm unless it goes from something really, really good and kind of
Mhm.
transcends to now something really bad, which means something negative probably hit your credit report. And you should go to one of the places that gives away credit reports at no cost and check that credit report to see if something new, possibly negative, has hit that report, which is causing the scores to be so much lower this month relative to last month.
Yeah, if it drops that much and you don't know why, you probably need to investigate immediately. Our next question is, what's the real difference between FICO and VantageScore? People hear those two names a lot, I'm sure, but
Yeah.
what is the actual difference between them?
So here's a good way to think. So in other words, FICO is a brand. VantageScore is a brand. Um, FICO is um, a brand of credit scores. It's also a company, and there are literally countless scoring systems that would fall underneath the umbrella of being a FICO branded score. We most commonly talk about, or as a consumer, are most familiar with the FICO credit bureau risk scores. So they're FICO scores that Chase may get from Equifax or Discover may get from Experian. Those are the FICO scores that we're most um, that we talk about the most because those are the ones that are most commonly used. They're used literally tens of billions of times every single year, which is multiple times the Earth's population, if that gives you any sort of idea of just how many times these scores are calculated annually and used annually. VantageScore is a completely different credit scoring platform. It is a product of it's a joint venture between the three credit reporting agencies, and they collectively built the VantageScore credit scoring system to compete with the FICO credit scoring system. FICO is built obviously by the company FICO of Fair Isaac, which is a publicly traded company that's been around since publicly traded anyways, for many decades. And they have a partnership with the credit bureaus, and the credit bureaus, through a licensing agreement, are allowed to use FICO's credit scoring software to calculate credit scores on their credit reports and then sell those to creditors. And so the difference is they're completely different scoring platforms. Are Pepsi and Coke. They're iPhone and Android. They kind of do the same thing, but no one would ever say that they are the same thing. Um, those are the differences. Here's some of the similarities. Number one is that they're both based entirely off of information on your credit report. So if something is not on your credit report, like your income or your net worth, things like that, educate level of education, employment, none of that stuff is on a credit report, and therefore it does not have any influence in your credit score because it can't. Credit scoring systems are very smart. They also have blinders on them. They can only see your credit report. So if information is not on a credit report, it can't affect your credit score. And so that applies both to FICO and to VantageScore. Second is the scaling of the score, or the range. So the published range of both FICO and VantageScore is 300 to 850. So that's another thing that I think, from my perspective anyways, it confuses consumers, because if you see a score and it's a 700, well, that could be a FICO score or it could be a VantageScore credit score. And really the only way you would know is look at the fine print on whatever website you're on or whatever paperwork you're looking at, or if there's any overt branding that indicates your FICO score is this, then obviously you'd know which score it is. But if you're on some websites, you may be looking at a VantageScore credit score, which is fine. It's still a legitimate tri-bureau credit score that's ECOA approved to use in the United States, and it's used quite often. But if you don't see the big four letters FICO, then you're not looking at a FICO score. So if your intent was to check your FICO score, then you're probably going to want to gravitate to some of the places where you can get a FICO score. If you don't really care, then you may end up on some websites that are giving away VantageScore credit scores.
So it's basically just two different ways to come to the same conclusion about your credit score.
Yeah, I mean, it's Ford and Chevrolet, right? There's
Yep.
nothing wrong with either of them. They're both perfectly fine. They both do the same thing, but they are not the same thing.
That's good to know. And our last question today, there's been a lot of talk about it. President Trump has proposed a 10% interest rate cap for 1 year. But hypothetically, what impact would that have on a credit card holder who pays their bill in full and on time?
Well, the impact on that person for interest rates is irrelevant. There is no impact. And again, interest on a credit card only occurs if you carry a balance from 1 month to the next, or you revolve a balance from 1 month to the next. The interest that you pay is kind of the fee that you're paying to the creditor to allow you to carry some portion of your balance from month to month, because technically now you've taken out some form of a loan, and interest applies to loans. So I have a lot of credit cards, John, and I have no idea what my interest rates are on any of them because I pay them in full every single month because I generally I use them as sparingly as I can. And that's really the position that you'd like to be in. So things like 10% caps on interest rates and average interest rates being in the 20s, all that stuff is great and it's very entertaining, but it's immaterial to your bottom line because you don't pay interest on your credit card balances. This whole topic of 10% caps on credit cards just kind of underscores and illustrates just how powerful a single tweet from the president can be. Unless I missed something, I'm pretty sure that this all came from a tweet or an X, whatever we're calling it these days. And so therefore there's not a whole lot of information because it was limited to like whatever a few hundred characters, but everyone in the world is talking about it. They're talking about it in Davos, the World Economic Forum.
Mhm.
They talked about it this morning on financial networks. My phone and email blew up the morning after the tweet to get comment about the effect of a 10% cap. And I've seen presidents of the mega banks have to field questions about it. What would this do? How would you have to change? So again, this is this is a big deal because it's getting attention now in different parts of the world. The challenge with capping an interest rate, which by the way, I understand why he's doing it. He's doing it because the average interest rate on credit cards, depending on who you believe, is somewhere between the high teens and into the 20s. And interest rates on retail store credit cards have always been into the 20s, regardless
Mhm.
of what your FICO score is. And so even someone who's got a killer FICO score is still going to have a very high interest rate on a credit card. And so capping the interest rate is a way to save consumers money because you're paying less to carry balances month over month. What we don't know is, well, we don't know a lot. We don't know if the idea of capping the interest rate is retroactive 12 months for the next 12 months, or as of today, for the next 12 months on pre existing debt. I did some research before I started talking about this, John. There are hundreds of millions of credit cards that are in commercial circulation today, consumer credit cards, hundreds of millions of them. Does that mean every single one of these is going to all of a sudden, boom, be capped at 10%? Or is it only cards that are opened as of some date? Meaning, all credit cards opened as of March 1st are going to have a 10% cap on the interest rate for the first 12 months, and then they can be adjusted upward accordingly. We don't know. We don't know the answer to that question because there's not a whole lot of detail around it. The other problem with the 10% cap is historically speaking, banks and the mega credit card issuers have avoided high risk consumers in times when there were essentially black swan events. So if you look at the most recent and memorable example is the 0809 meltdown or financial crisis. And some of the people watching this may not, may have been 10 years old during that, but I promise you it was a real thing. And what happened was um, high risk loan products were eliminated and have never come back, which means certain consumers couldn't get loans for a period of time because they were high risk. And banks, it's called the flight to quality, meaning that they stopped doing business with consumers that were high risk. And high risk at a 10% cap on a credit card doesn't necessarily mean people with bad FICO scores. It could mean people with average FICO scores. And you don't need to believe me. Number one, look at historically what banks have done. And number two, you can look at the quotes from the CEOs of the mega banks and what they're saying they would have to do if interest rates were capped. And some of the things that you will hear are the same things that I've been telling people, which is because interest rates are used to subsidize risk because a credit card is a very risky product. They're usually unsecured. And if you default on it, the bank can't come repossess something like they can come get your car, they can come get your house. The default rate on credit cards is much higher than the default rate on loans because usually loans are secured by some asset, some piece of property. So banks have to charge more to subsidize the risk of the product itself. Now, if they say 10%, by the way, no one has 10%. Even people who have killer FICO scores, they don't have a 10% interest rate on a credit card because even teaser rates expire and go to something much
Yeah.
higher than 10%. So 10%, I don't know where it came from, if it was just arbitrary or someone put some thought to it. But what would happen if the credit card issuers were limited to only 10% is that you would have to have elite level FICO scores to get a credit card. You would have to have a FICO score that basically tells the bank there is zero chance of me not paying you back. I will bend over backwards and miss a meal before I will miss a payment. That's what the lender is going to want to see if they cap the interest rate at 10%. So while I am wholeheartedly behind any idea that we can come up with to help consumers, right? And the president's thrown out the 50-year mortgage. The president has thrown out portable APRs on mortgage loans, which I love. I think that's a fantastic idea. That one would get my vote if anyone cared to listen to me. And now he's thrown out this 10% cap. So regardless of what you think about the man, you have to applaud at least some of the creativity that's coming out of the White House with respect to trying to save consumers money. It's just like if you listen to the banks who are risk averse, just as a matter of being a bank, this could have unintended consequences. If you look, for example, look at American Express. American Express does not have a subprime product, right? No one with FICO 580 goes out and gets an American Express card. There is no product for them. That consumer has to go to a different bank that does have a subprime product. So if you're looking at some of the Cap One products, you have to look at the Credit One Bank products, some of the other subprime credit card issuers. They tailor their products to consumers who have bad credit. That's their target audience. They all charge higher interest rates than 10%. I can assure you that. If you now tell all them, sorry, we have to cap you at 10%. What does that mean? That we're just going to not do business anymore? That's crazy. So I think I like the hypothesis. It's just a matter of what does it actually mean that's problematic. And of course, all we have is a tweet and
Yeah.
speculation. So we don't really have a whole lot of details wrapped around the idea at this point.
And for those people who do pay their bill off in full and on time, probably I would guess have a high score. But would those banks pull back from some rewards or charge higher annual fees, possibly to recoup some of that because of a 10% interest rate?
Every bad thing you can think of is on the block. Number one, closing existing accounts, even if you pay in full every month. Number two, because remember, if you pay in full every month, then you are barely above the $0 line on the revenue meter,
Hmm.
right? Because the only thing you're
Yep.
generating is swipe fee or interchange income. So you're really not a terribly profitable cardholder if you pay in full every month. So they may want you to revolve at least some of your balance because then you're generating more interest income. Not as much, obviously, at 10%. So they may close your account. They may lower your credit limit to something much lower, maybe even they may even lower your, it's called chasing the balance. They may lower your credit limit to whatever your balance is. And every time you make a payment, they just keep lowering your credit limit
Mm.
to whatever your balance currently is, which renders the card useless other than you can make payments on your existing debt. But they haven't closed your account. So they could increase your limit when this 12 months expires and just go back to the status quo. They could increase the minimum credit score requirements for any new accounts, which they absolutely would do, to only let in the truly elite applicant in the door. Or they would do things like what you just suggested, which is to start kind of watering down the different features and benefits of cards. I can tell you, consumers don't want to lose their features and benefits. They
Yeah.
love their features and benefits. But unfortunately, features and benefits are paid for to some extent by interest. And
Hmm.
so if you can't give a consumer something if you don't have a way to pay for what you're giving to the consumer. So what do? You eliminate that feature or benefit. And you're going to have an angry credit card holder who loves that they're only paying 10% interest instead of 24% interest, but they've also lost their miles or their points or their
Yep.
cash back or whatever else it is that they really love about their card.
Yeah. And I think that's a good way to look at it because, you hear it, it sounds great from a consumer debt standpoint, but it's like pulling on a little thread and you don't know exactly what's going to happen. And it could affect any cardholder,
Yep.
just about. So,
Well, if history has taught us anything, again, all you have to do is go back to 2008, 2009, what did the banks do?
Yep.
No one was getting mortgage loans, right? Unless you were truly, truly elite. And the minimum requirements for other forms of credit became much harder to hit because of the flight to quality. And so this is not an unprecedented thing to kind of change the rules, if you will, in midstream. And unfortunately, banks, they don't like that, and so they generally react angrily when things like that happen. And so again, great hypothesis, looks fantastic on a marquee 10%. But again, you start pulling that, or whatever what's the food service version, you peel back the onion. The minute you
Yeah.
start doing stuff like that and you start wondering, wait a minute, where the heck did my rewards points go? Well, we don't have any way to pay for them right now.
Yeah. Well, I think those are all great insights, and we'll see what happens. And, maybe we'll be talking about it the next time.
Hopefully, I mean,
So
I hope we're talking about the portable interest rate on mortgages. That again, that's an awesome idea. I would love to drag my 2.75% with me wherever I go get my next mortgage.
I'd love to talk about that next time too. Well, thanks a lot for joining us, and we'll talk to you next time.
Thank you, John, for having me as always.